To have a deficit of $5.3 trillion is like 25% of GDP. I mean, this is absolutely massive. And it is a continuance of something that I've said in the past, and that is that the American government is already stuck on a hyperinflationary course. And by that, I mean that the only way in which they can finance themselves is by printing money. There is no escape, I think, for the American government from that dilemma. The point that's interesting to me is at what point in this situation, where we have already got, under the Chapwood Index, a rate of inflation of approximately 10%, compared with the CPI's 1.7%, at what point are people going to suddenly realize, hold on a minute, this 1.7%, or let's say it rises to 2.2%, is a load of absolute hogwash, and they then don't believe it. To me, it is remarkable that people within the system, investment managers, investment strategists, economists, and all the rest of it, don't understand that the CPI is deliberately suppressing the numbers, and therefore the whole of the financial system is completely mispriced. Nobody seems to understand this. They don't want to look at it. Everybody needs the dollar. There will come a point where suddenly they don't need the dollar, and then you're in trouble. And this is roughly where America seems to be now. And it's made particularly more acute at a time when the rate of monetary inflation is about to accelerate very substantially.
This is Donegan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com. Welcome back to Liberty and Finance. We have a distinguished returning guest. Alasdair Macleod is the head of research at goldmoney.com. He's been with us several times in the past, always highly anticipated by our viewers. Alasdair, thank you for joining us this Wednesday, January 20th, 2020.
That's my pleasure, DK.
I'm glad we're able to have this conversation at this time. There's a lot of people who are predicting convulsive events today. I don't know what will happen, but we certainly are at a time of change. You and I both mentioned that we're both COVID-free, which we're grateful for at this time. But as there's a changing of the guard, perhaps, probably, expected to be going on in the U.S. today, and also wanted to get you to bring us up to date on what you foresee as the likely economic and financial impact of that. But before we get to that, I wanted to ask you about a tweet that you sent out less than a week ago, which I've been retweeting and mentioning on interviews because I found it appeared to me to be significant. And that was a manager of the IMF writing to governments that they should figure out how much they can possibly spend and then spend more than that in order to prevent a collapse. And it certainly plays into both discussions we've had about the need for ever-increasing exponential increases in currency as well as spending. And then this couple of statements that were in the article that seemed particularly telling from this IMF manager, saying that we have to prevent a collapse, especially in considering the shutdowns of both production and consumption, which we have done on purpose. So if you could kind of tell us from your viewpoint why you tweeted it, what you see as the significant takeaways from that.
Well, quite simply, it's a Keynesian statement. I mean, the IMF basically is staffed by Keynesian economists, and they believe that the route to economic growth is ever-increasing monetary stimulus. And so the other side of monetary stimulus, obviously, is a budget deficit. So it's deficit spending. And they're saying that you need to increase your deficits as much as possible to rescue the world economy from potentially the worst recession we've seen since the Depression. And I mean, it's what the Keynesian economists say all the time. Of course, what they don't look at is the other side of the equation, and that is the effect on people who earn the currency, who save in the currency, and who are paid pensions in the currency. And the answer there basically is that all that is basically debased. There are huge, great wealth transfers involved in all this money printing to pay for the budget deficits. And that, of course, is not acknowledged at all. And because it doesn't appear in any statistics, it is completely ignored. But the effect of that is to basically impoverish everybody. I mean, if it was otherwise, then in the great inflation in Germany, all the money printing would have made everybody terribly rich and, got the economy going and, rescued it and all the rest of it. As it was, I think we all know what happened there.
Certainly. And in this case, the fact that the IMF is saying that governments should spend more than they think they can or more than they can afford to prevent collapse is, I mean, it seems rather blatant to saying what you've been saying or others have been saying all along, but here it's coming from a very official source.
They're very worried. I think it's the short answer. I mean, put yourself in the shoes of the new U.S. Treasury Secretary, assuming it's Ms. Yellen, for example, or indeed the head of the Fed. I mean, they see this situation, I think, as being incredibly alarming. There is no doubt that these COVID shutdowns have really destroyed large parts of everyone's economy. And it's not going to be easy to recover from that. But of course, the state invariably thinks that they are the agent to bring that recovery about. They don't see that the private sector on its own can possibly do it. And that's why we have this sort of scrambling for anything. And of course, at this time, which must have also heightened their concerns over this situation, we've seen prices of cryptocurrencies like Bitcoin just double. And it's interesting because that sort of happened in the interregnum, between Trump being unelected, Biden being elected, and Biden actually taking office. So the authorities in New York, the monetary authorities, the government, the regulators, have basically let this one pass because I don't think there was anyone really in control of new initiatives, if you see what I mean. So you can see that things are sort of run away when there's nobody been at the helm. So it's going to be interesting to see what happens in that respect once Biden has appointed his administration and they start to try to get to grips with the overall situation.
You've been, just so I can grasp everything you've been saying here, basically this runaway Keynesian model that we've been following for quite some time is really coming to a head. You've predicted that the time is very short, that you see we won't run into before we run into a real crisis, banking crisis, fiat crisis. And here you've got a manager of the IMF instructing governments all over the world to outspend their limits, and you're pointing out that will hurt all those people in the world who earn wages, who save their wages, and who are paid out either in pensions or Social Security, anything, because the debasement of the currency, lacking protection. So, and clearly it seems like the keepers of the system aren't necessarily acting in the best interest of those majority of people who do earn and save and have a pension, that kind of thing. So I guess we need to get around to talking about how people can take care of their own household if the keepers aren't taking care of things in a way that's for our own good. Before we get to that, maybe you can talk to us. You mentioned the potential Biden presidency starting today. You've done some analysis looking forward on what you think the implications of that will be financially. So could you tell us some of the results of that research you've been doing?
Yes, sure. Basically, we've got the Congressional Budget Office has forecast the budget deficit for this current year. But that forecast was made before there was a sort of protection program for wages. And on top of that, I mean, that was about, 900 billion, something like that, or 700 billion. I can't remember the exact figures. And then you've got Biden's 1.9 billion rescue packages. And that's just to rescue the economy from COVID. It's not to stimulate the economy to go any further. But if you add those three things together, you've got roughly 5.3 trillion of budget deficit on what has been proposed so far. And it is quite possible that by the time extra stimulus is put in place, such as the greening, if you like, of the American economy, which I know is very much on Biden's agenda, plus, investment to try and get the thing going and, get the economic recovery and all the rest of it. So really, we're looking at $5.3 trillion of deficit, budget deficit, before all that extra stuff comes through. Whether it comes through or not, I don't know. I suspect it won't at the end of the day. But to have a deficit of $5.3 trillion is like 25% of GDP. I mean, this is absolutely massive. And it is a continuance of something that I've said in the past, and that is that the American government is already stuck on a hyperinflationary course. And by that, I mean that the only way in which they can finance themselves is by printing money. There is no escape, I think, for the American government from that dilemma. And effectively, they're bringing that forward, I think, with a more socialist policy than we had under Donald Trump. Though how different it would be, one doesn't know. But all I would say is that the ultimate collapse of the currency is being brought forward by these excessive monetary plans. There is another aspect of this which I'd just like to go into. If you look at what's been happening to the savings ratio, the rate of savings, there has been a spike up and it's coming down off that spike. And that spike was really identified with perhaps a combination of people not going out and spending, the helicopter money drop that you had in the tail end of last year. And there is a further proposal, I think, for $1,400 per adult in the Biden package. And so that rate will spike up again. But when that ends, let us assume that some sort of normality returns. And I don't mean economic reality. I mean reality in the sense that we can go out and actually do things, or we can go and try and find jobs or whatever it might be. That money is very excessive in terms of what people are used to holding. So they will reduce that stockpile, that hoarded money, if you like. Now that, I think, will put into the US economy a further $2.5 trillion of spending, compared with what had happened if these helicopter drops had not happened. Now, if you can imagine $2.5 trillion in an economy of around about $21 trillion, the effect of that will be on, the marginal effect of that on prices will be to drive them up quite sharply. So we then have a problem that when you see prices rising as an ordinary American, do you take the view that you should reduce your dollars in return for goods which you don't necessarily need immediately, but you might need in the near future? In other words, will you reduce your liquidity levels even further? The reason this is important is because this is the means by which monetary inflation is translated into price inflation. If you get a situation where, let's look at an extreme, let's say all of us citizens, I call myself an American citizen for the purpose of this example, if we all decide that we want to minimize our holding of dollar liquidity and go out and buy goods because goods prices are rising, goods and services prices are rising, then we're going to create yet further falls in the purchasing power of the dollar, because it's the purchasing power of the dollar that's going down, not prices that are rising. If anything, in real terms, prices are probably falling, but measured in dollars, because the dollar's going down the toilet, you have this problem that, we're sitting here with what little liquidity we've got left thinking, what on earth should we do with it? And the answer is, it's exactly the same as you had in Germany back in 1923. You just get what you can of your liquidity and go and spend it before the prices go even higher. And that, if you like, is the sort of final collapse in the purchasing power of any fiat currency. So to recap slightly, what I'm saying is that the effect of 2 helicopter drops plus being stuck inside has probably added something over $2.5 trillion of spending power in the consumer's hands. Now, a Keynesian economist will say, well, this is just what we need in order to get the economy going again. But the problem is the production for this excess demand isn't there. The production is all mired in supply chain problems, companies that have gone bankrupt, companies that can't borrow any more from their bankers because the bankers are trying to reduce their overall credit exposure, and so on and so forth. So you've got this mismatch. It's all very well putting $2.5 trillion of extra spending into the economy, but if you haven't got the production, you can see what's going to happen to prices. The only safety valve in this, of course, is the ability to buy product from abroad. So what we will see is that while the budget deficit looks like over $5 trillion, so will, once spending is normalized, if we can just put it that way for a moment, so will the trade deficit. That will rise to over $5 trillion as well. Now, what are the political implications of that? So, this is turning out to be an unholy mess. It really is. And I don't think it's going to be terribly long before the honeymoon with President Biden's moving into office. I think it'll be terribly long before suddenly they're running into huge, great difficulties.
So I wanted to make sure that I understood the one part you're talking about. It sounds like a runaway vicious cycle when people come out of lockdown and they've had more in savings than they're accustomed to in the past. And you've got to give them a little bit of leeway there because there's a bit of a mindset shift. People are on a more cautious footing now than they were back in the roaring 20s era that we've come out of, where everything went up all the time, and they go, maybe things can change and go for the worst. Maybe I should have a plan B. Maybe I should have a rainy day fund. So that all those savings might not all find their way back into circulation, but there will be some reverting back to the comfort zone of the normal savings rate.
I take the point, but when you start to see prices rising.
That's the other part. That's what we're getting to. So when this starts, then you're going to have more dollars chasing fewer goods. That was the added dimension there. And all of a sudden, there becomes this psychological panic of feeding frenzy of, if I don't get mine now, there won't be any to get. So I better dump some of this junk money while I can and get something real. And meanwhile, that's just a vicious cycle, and away it goes.
Yeah. Now, the interesting thing is that if you look at independent estimates of inflation, and the one which is publicly available without a subscription, obviously, is the Chapwood Index. Now, the Chapwood Index since 2010 has shown an annual average increase in prices of just under 10% every year. It's been, with a little variation, it's been pretty constant, and there's variations from city to city. I mean, cities like Los Angeles and New York tend to have an inflation rate looking about 12%, whereas some of the smaller cities are probably looking at about 8 or even 7.5%. So there is a bit of movement in that. You could also claim that the Chapwood Index isn't representative of whatever you want it to be representative of, because actually all it is 500 commonly bought items in 50 cities. So you've got 2,500 data points around the nation, which is done every 6 months. So that's what we're talking about. Now, compared with the BLS, with their massive collection of price data and all the rest of it, some people will claim, well, of course, this can't be valid. But it is valid it is valid because it's the commonly bought items. If you look at the BLS thing, nobody buys everything in that. It's complete nonsense. We're talking about the personal experience of people living in cities. So we have seen a rate of inflation measured on that yardstick of roughly 10% every year since 2010. Now, meanwhile, the CPS says that the rate of inflation is around about 1.7, 1.8%. Well, we do know that going back into the 80s, and this is something John Williams of Shadowstat has been emphasizing, and he corrects his figures for all the changes that have been put in, designed to reduce the apparent rate of price inflation. We do know that this is a process that started shortly after the 1970s, when inflation took off and governments, in a fit of something or other, decided to protect their citizens from future inflation by index linking various things. I mean, things like, whether it's pensions or
saving. You even had Series I savings bonds in the U.S., which were inflation protected. It was great for a while.
Yeah, but I mean, it's not protecting you against anything now because the supposed rate of inflation is ridiculous. It's not good for it's known. But the point that's interesting to me is at what point in this situation where we have already got under the Chapwood Index a rate of inflation of approximately 10%. Compared with the CPI's 1.7%, at what point are people going to suddenly realize, hold on a minute, this 1.7%, or let's say it rises to 2.2%, is a load of absolute hogwash, and they then don't believe it. To me, it is remarkable that people within the system, investment managers, investment strategists, economists, and all the rest of it, don't understand that the CPI is deliberately suppressing the numbers, and therefore the whole of the financial system is completely mispriced. Nobody seems to understand this. They don't want to look at it, perhaps. So we're in this situation where suddenly there's going to be discovery. What happens when that discovery happens? Well, I can tell you one thing, interest rates are not going to be hanging around, 0 to 1%. They're going to be considerably higher. What does that do to everything? It completely destroys US government's finances, sort of happily running budgets of 5 trillion plus. That's not going to be possible anymore. So, the whole situation, I think, is extremely concerning. We've got a potential banking crisis. I'm surprised it hasn't happened yet. I forecasted in the past that it should have happened by now. I mean, it has in the sense that we know that behind the scenes there have been attempts to recapitalize the banking system. I mean, this is part of what happens when you have quantitative easing. Also, you had the repo crisis way back in September 2019. I mean, basically, there's been sort of creaks and groans within the banking system, which are concerning. And now we have major industries falling over, sort of travel, hospitality, and aspects of other industries which otherwise, shouldn't have been terribly badly affected with supply chain disruptions and all the rest of it. I mean, the mounting bad debts within the global banking system basically must destabilize it. And so far, what the central banks have done is they've sort of tried to lean on the banks and say, well, you do lend to corporates or whatever, and we will give a 1-year guarantee or whatever. They've come up with these schemes, if you
to
like,
backstop lenders,
to backstop lenders, and you're going to see more of that. Of course, you are. But you have to ask yourself, what is the cost of all this? And remember that since the Lehman crisis, there has been no fundamental reform of the American economy.
I want to stay on that point just for a minute, because that's so many of guests have said the problem never got structurally solved. It got papered over with liquidity, and then the banks went forward in that backstopped no risk environment to them and went out on leverage, derivatives, blah, blah, blah. So now it's much, many times worse. Then we have other guests on who say, oh, no, the U.S. banks are much better capitalized now than they were in 2000, right before the global financial collapse. It's only the European banks that are out on a limb. Can you please set us straight from your viewpoint on that?
Okay. It is true that the U.S. banking system is generally the best capitalized banking system of the major currencies in the world. That is true. you only have to look at the share prices of people like JP Morgan, Goldman Sachs, Citibank, Bank of America Corporation, and so on, to see that the relationship between the share prices, or if you like, the market capitalization and the balance sheet equity, is actually not too far adrift. If, on the other hand, you go into the Eurozone, then you can see that there are major GSIBs, that's globally systemically important banks, whose share prices are 20% of book value, or 25%, or 30% of book value. In other words, what the market is saying is that this bank basically is bust, but given that there is a limitation on shareholders losing money, like we just lose your money, you don't have any further liabilities, this is limited liability, then, 20 cents on the dollar or 20 cents on the euro is option money. So they're being priced for option money. The same is true of the Chinese banking system, which is an interesting one, because we would otherwise assume, and I think it is still right to assume, that the major Chinese GSIBs, of which I think from memory there are about 4, will be rescued by the Chinese government, will be underwritten by the Chinese government if anything major happens. So, but as far as the share prices are concerned, they're saying no. They're saying this lot are in trouble. You look at Britain. We've got a problem too, because some of our banks here, I mean, you're looking at, from memory, someone like Lloyd's is about 45%. The shares are about 45% of book value. Barclays are less than that. But we've got 2 majors. We've got Hong Kong Shanghai Bank, which, and also Standard Chartered, whose basic business is in the Far East and particularly in Hong Kong and China. So there is a risk there. There's a political risk as well. We have got major risks in the banking system. And on top of that, there is going to be an acceleration of bad debts, or what they call non-performing loans, due to COVID. I mean, it is as simple as that. I could go on and on and on about these difficulties, but the underlying problem we face is that at a time of great economic and monetary fragility, you've got the IMF, as you pointed out, you have got Joe Biden turning around and saying, we're going to spend our way out of trouble. Yeah, I think that horse has already bolted.
When you mentioned the banks are, or even the U.S. banks are better capitalized, if you look at them from a market capitalization, what the market is saying they're worth versus their assets, how solid are those assets if they're based on businesses and commercial real estate and other things that are mortgages that aren't going to get paid and that kind of stuff in this climate? Well,
you're absolutely right. All I've been talking about so far is how the market rates these banks.
Yeah.
But if you have a bank which has a ratio of assets to equity, balance sheet equity, of say 10 times, you've only got to lose 10% of your loans, of the asset side of your balance sheet, right, before your equity is wiped out. And it's something, just to sort of put something straight, it's not a situation that can be addressed by increasing bank reserves, because the thing that really matters is the relationship between the balance sheet total and the equity. And I take it even further, and I say it is also extremely important to look at how the market rates that equity. I mean, with most banks, most major banks in America, it's almost sort of 1-to-1. I mean, they're trading at something like book value. There is one that doesn't, considerably less than book value, and that's Wells Fargo. But other than that, you can see that, looking elsewhere, you've got huge, great systemic risks, certainly in the Eurozone, certainly from the UK, and it would appear from China. We have to assume that every central bank involved will underwrite their banking systems. But when we get to that point and we see the real cost of all this, what's that going to do to the purchasing power of currencies? I would suggest that it's going to undermine them even further.
We've had in the past guests who've talked about stress tests that are applied to banks, and we've had a rather jaundiced report on how I guess, fair those really are, because I think maybe you mentioned that stress tests are being applied in such a way that so the banks pass them so everybody calms down. But if some of the stress test is saying, gee, what if with all the investments and all the assets that the bank has, what if markets dropped by a certain percent, like equity markets? Or what if, like you said, even in the Eurozone, that they're basically sweeping together problem non-performing loans and wrapping them as a package and now counting it as an asset, that kind of thing. I mean, at what point does some of this stuff blow up even independent of all the other dynamics that you've mentioned so far?
I think the answer is at the most inconvenient moment.
Yeah, okay.
That's what tends to happen. It's, you suddenly find, you think, oh, well, we've dealt with this problem. And then suddenly this huge, great monster, the cliche, the elephant in the room, suddenly sits on everything. And it's difficult to know when it will happen. But all I can say is that there are all these problems mounting and mounting and mounting. And the response to try and deal with it by printing yet more and more money can only do one thing, and that is collapse the currencies. We saw this way back 300 years ago in France. John Law managed to get control over the money supply. He became effectively the controller of the money. And as well as that, his bank had the privilege of being appointed the central bank. It changed from it changed to Banque Royale, it was the royal bank. In other words, in those days, France's finances were basically the king's finances. The Banque Royale was then issuing livres out of thin air to buy the Mississippi Venture, the company which he had managed to accumulate, which got a monopoly on France's imports and exports. This is really big stuff. And this is around about November 1719. The currency was beginning to weaken from all the money printing. The prices, food prices were beginning to rise in the provinces and so on and so forth. So there was, there were a few rumblings. Rather, like we have now, we can see food prices beginning to rise now. It's the same sort of situation. And what happened was, John Law was going to merge his central bank, Banque Royale, with his Mississippi Ventures in a grand scheme. And that was due to happen on the 28th of February, 1720. It actually, I think it probably went through 2 or 3 days later. The histories seem to be rather sort of vague on this. But the point was that the guy who really knew how to play this was Cantillon, Richard Cantillon, who was an Irish-French banker. And he was an extremely astute individual. He never bought into John Law's scheme at all. He made his first fortune basically by lending money to people who wanted to buy shares, these partly paid shares in the Mississippi Venture. But he immediately sold the collateral that he got without telling these people. And of course, when the whole thing went bust, he started suing for his money back. So he'd got his money twice on that one, effectively. But in the middle of this, he reckoned that the best way to play this was not to short the shares, but to sell the livre on the London and the Amsterdam foreign exchanges, which he did in enormous quantity. At the end of the whole process, you had the collapse of the venture, the bubble popped, if you like, but you also had the collapse of the currency. And by around about September 1720, the shares were worth a nominal 2,000 or 3,000 livres, having fallen from about 12,000 livres from around about January, which was more or less the peak. But the currency fell from whatever it was against the pound and against the florin in Amsterdam to zero, absolute zero. The way to have played that was to short the currency. So here we are in the situation where the John Law scheme has gone global. Because what has the Fed been doing? The Fed has been puffing up markets to create a wealth effect and to keep the cost of borrowing for the government down to the lowest possible level by suppressing interest rates and by buying in government debt at very, very low yields. So it is exactly the same as John Law's scheme. And it means basically that when it goes pop, and bear in mind all these big debts that are mounting within the economy because of COVID and all the rest of it, and the reluctance of bankers to lend without further guarantees from the government, you can see it's exactly the same situation that John Law faced in 1720. So what happens to the dollar? It's in the toilet. And the same, incidentally, for every other currency, because we're all doing exactly the same thing to a greater or lesser extent, mostly to a lesser extent.
This theme that you just mentioned about the demise of all fiat currencies, including the current benchmark when the dollar is common among guests we've had. There is a counter argument that we've had proposed to us that, well, the dollar is still the least ugly horse at the slaughterhouse or something. So therefore, it's going to be the one that people flock to globally. Are you seeing actual people moving their? I mean, if you follow the money, if you look at where people are voting with their feet, what reality are we seeing? Is it actually the Fed having to step in and sop up the unbought bonds that the other countries don't want? Do we have actual evidence of people moving their money or moving out of the dollar? Is there any indication of that, or is it just historical precedent that we fall back on?
It's early stages in this situation, a situation which could accelerate, and I think probably will accelerate quite quickly once it gets going. You have to bear in mind that foreigners already own, and this is according to the US Treasury tick figures and banking returns, they own a total of around about $27 trillion of financial assets and cash on deposit. The cash on deposit is about $6.5 trillion. And the rest, which is about a short 20 trillion, is basically equities, bonds, corporate bonds, agency bonds, US treasuries, and so on and so forth. Now, to own roughly 140% of a country's GDP, to own assets in that currency is a very extreme situation. Now, you can justify it to a degree, but not as much, I would argue, on the basis that everybody needs dollars because internationally things are priced in dollars. That undoubtedly is true. But when you see that the economic outlook is not nearly as positive as it was, let us say, a year ago, then what do? You've got excess dollars, because the reason that, as an international company or indeed national government, the reason you own dollars is because you expect those dollars to be used in future as part of trade. So you will have if you've got a trade surplus with America, you will tend to run a surplus on your dollars because you want liquidity on the one hand, and on the other hand, you're going to acquire those dollars anyway. And so probably what you do is you invest it back into US treasuries or whatever it is that you want. You've also got portfolio allocations, which are massive. I think the last tick figures, they were talking about something like $8 trillion invested in US equities. I mean, this is an enormous figure. The increase in the total level of US dollar investment and cash has actually come really from the portfolio effect of rising prices in the equity market. That's added something like a couple of trillion in the last 6 months, 8 months, whatever. So the point I would make is that the dollar is over-owned. And as soon as the dollar starts going down, and from March last year, it's already fallen from 103 on the trade weighted down to currently around about 90. If you get the feeling as a foreigner that this is going to go down, and you're going to also see interest rates rise, and we've already seen the yield on the 10-year US Treasury bottom out, and it's showing a very clear signal that it's heading higher, which basically means that your bond prices go down. I think that the evidence is mounting that foreigners are going to turn more aggressive sellers over the next few months rather than just holding their position. Now, this matters as far as the Fed is concerned, because in the past, the trade deficit has been met with a balance of payments, which basically means that the money which has come from the US trade deficit and gone into foreign hands has been reinvested in dollars into the economy. So the Fed has not had to deal with a situation where foreign investors have become absent. They're now in a situation where not only are they having to support the US government deficit, but they are also likely to have to mop up any overseas selling of US Treasury debt and agency debt as well at the same time. So they could find that their balance sheet expands more than that $5 billion deficit.
Yeah, that wasn't even one of the factors that you mentioned when you were listing reasons that were going to drive that budget deficit. So you've just opened my eyes one more time. I know this is not the first time you said it. It's the first time it's sunk in to the way that it did now. But as a trade deficit, America has been, I've heard Americans talking like, oh, how clever are we? We get real things from China or other countries like cars, computers, technology, whatever, garments sent to us, and we send them paper dollars, and so we're getting real things in exchange for not real things. How clever is that? But you're saying not so clever if then you're basically that they're going to reinvest those things by buying up your companies, your real estate, your country. So basically you're enjoying perishable consumer goods and in exchange for selling out the assets of your country and becoming further in debt to them.
That is not really a problem. That is something that would happen, if you like, in a free market. In a free market, which is the best situation we can imagine. I could buy things in America, you could buy things in Britain. There would be no restriction on that at all, and neither should there be. The problem basically is that there comes a point where if you trade on this situation that everybody needs the dollar, there will come a point where suddenly they don't need the dollar, and then you're in trouble. And this is roughly where America seems to be now. And it's made particularly more acute at a time when the rate of monetary inflation is about to accelerate very substantially under this new administration. Not entirely this new administration's fault, I must add. I mean, this is going to happen anyway, because you've got this COVID thing, you've got the end of the bank credit cycle, you've had the trade wars between America and China, bringing in tariffs and all the rest of it. It's become a very messy situation for Joe Biden to inherit. But having said that, I can't see that he can do anything to resolve the situation, and his inclination and his advice will be that you must print more money or you must expand your deficit even further in order to rescue the economy. And as you said earlier, we've even got the head of the IMF saying it.
Alasdair, this is so engulfing for the ordinary individual, the scope and scale of this. We find ourselves having seen precedent before in history that this does not end well. We see that everywhere we look, you keep saying, "Hey," and yet there's more. It's not that's not all the bad news. So we're going to have you back to help us unpack that more. But it sounds like we're certainly not only are we not out of the woods, we don't even see the edges of the woods, and it looks like it's going to maybe get significantly darker before. I promised in the beginning we'd give you one chance to say what people can do about it if they can't control all these big decision makers and these dynamics. If there's just a few things on the ordinary person's individual household level that they can do.
I think the only advice I can give is that you have to have some sound money. I'd call it an insurance, just in case this happens. If you think it's very likely to happen, then obviously you have more sound money. The sound money being gold and also silver, though that's slightly more complex. There is only one way out of this awful situation, and that is for central banks to reintroduce a gold standard. But it's got to be a workable standard. Now, when we get there, obviously, currencies will have fallen a hell of a long way. But the advantage of having a fiat currency at that stage is that you can use it as a means of distributing sound money around the nation, because everyone will have a balance of dollars, let's say, in America, which are otherwise completely worthless. But it is a means. If you can just then introduce a gold standard, in other words, a gold exchange standard, so that you can exchange your dollars for actual coins, for gold coins, then you will stabilize the currency. But that's not the only thing that the government has to do. The other thing the government has to do is to curtail its spending drastically. It must bring its budget back into balance. Unless it does that, then no gold standard is going to last terribly long. They're going to have to devalue again. And you find that the way that happens is international markets will just have a run against any currency which is not on a gold standard. But it will be a global thing because every central bank is in exactly the same situation. There are very few central banks that don't own any gold. It's the only thing they have in the absence of fiat currency to act as money. And governments must have money, because if they have no money at all, they don't pay the police, they don't pay the army, they don't pay all the bureaucrats, they don't pay the politicians, and so on and so on. And they cannot operate without money. So there will come a point in the collapse of the fiat currencies where they have to take the one practical option open to them. And in that sense, gold will very definitely be money. Some countries won't actually do it properly, and they will fail, and they will pay the price of it. Silver will also be a subsidiary form of money, and I think rather than get into the argument about bimetallic standards and all the rest of it, it's actually quite easy to deal with this. If you had silver coinage, which was valued, and it would probably have to come from the market in terms of value, say it's something like 20 to 25 ounces to 1 ounce of gold. On that basis, you can circulate silver coins. That would not be a problem. So, you're then going back onto a standard which is actually physically backed. And that is so important. There is no other option. People have told me about, can you use Bitcoin? I mean, central banks don't have Bitcoin. And not only that, but it's completely impractical, because can you imagine a bond market operating in Bitcoin? I mean, where, let's say you borrow Bitcoin in order to pay it back in 5 years' time, what's going to be the final value? You know that the final value in terms of purchasing power would be considerably higher than it is today. So what are you going to do with that, with those Bitcoin? I mean, the answer is, you want to actually be the other way around. You certainly don't want to manufacture anything or borrow money in order to borrow Bitcoin to manufacture anything, because your final price of goods measured in Bitcoin will just make the whole process a complete waste of time and a loss leader. So manufacturing would stop. You need a flexible currency, and that's what gold actually does offer you. Flexible without being under the control of governments, because governments always abuse that control.
And they have proven their unwillingness to yield that control too. So that's a big impediment to adopting that standard that requires that they do that.
Yeah, but the impediment will be overcome by the reality that if they don't do it, they haven't got anything.
It would be refreshing in one way to see natural law reassert itself in this era. It seems like for the past several decades it's been defied to absurd limits, but we're glad every time you visit us that you give us a dose of reality, get our feet back on the ground. Any parting thoughts where people can find your writing and so on? Yeah,
goldmoney.com, Insights. I write every Thursday, and it comes out sort of afternoonish, Eastern Standard Time. I write a market report on Fridays as well, which covers precious metals, so you might be interested in looking at that. But the one thought I would like to leave all your viewers with is, with the way things are going, you must make sure that you've got the insurance of some sound money. And by sound money, I don't mean the paper equivalent. I mean the real stuff, and that's gold and silver. Just get a bit of insurance against the worst and hope it doesn't happen.
And folks, make sure that you can stay in touch with us no matter what happens by joining our free email newsletter by going to libertyandfinance.com. Put your name and an email address in there. We'll get you on our newsletter. It comes out 3 times a week. You'll see all of Alasdair's interviews with his descriptions and links, as well as all of our other guests. And you'll also find us on Brighteon, and you'll also find us on Rumble. So make sure you look for us there, because none of us can put all our eggs in one basket in these interesting times. Alasdair, as always, thank you for joining us on Liberty and Finance.
That's my pleasure, DK.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today. To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com. Bullion Sales. You'll see my name, Dunnigan Kaiser, my phone number, and my associate Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.